We have with us today Mr. Vikash Wadekar, Head of Sales and Distribution for Passive Funds at Motilal Oswal AMC. Welcome, Vikash. Vikash has worked with various mutual funds on the institutional sales side over the last 19 years, starting his career with IIFL Mutual Fund, ING, Benchmark Mutual Fund, and Union KBC Mutual Fund. He was instrumental in setting up the BSC Star platform. He has also ventured in one of the fintech platforms for mutual fund advisors. He has spent extensive time with Benchmark Mutual Fund, a pioneer of ETFs and indexing in India. Today, we will understand what is passive investing and the importance of low volatility in wealth creation. Motilal Oswal AMC has launched a low volatility ETF and index fund so that investors can benefit from this crucial aspect of wealth creation. I would also like to introduce Tushit Thakkar. He is a quant analyst for PMS and AIF schemes at Motilal Oswal AMC. He is responsible for research on factors and systemic quants at the firm. He has over 4 years of experience in capital markets, ranging from research, construction, and management of various investment strategies. Prior to Motilal, he has worked with ICICI Prudential AMC and Morgan Stanley Capital International. Welcome, Tushit.
Thank you.
In the second half of this session, I will take you all through IIFL's platform dedicated for ETFs called ET5, wherein you will see we have created theme-based baskets to make investing in ETFs absolutely simple. So with that, I will hand it over to Vikash. Before that, participants, if you all have any questions, please drop it into the Q&A section and we'll take up as many as time permits. Over to you, Vikash.
Yeah, thank you, Edley, and thank you all the investors for joining on this call. Thank you, IIFL Securities, for arranging this. Yeah, so wealth creation is actually very boring. That's what I hear from Motilal ji. Okay, because wealth creation needs your patience and simplicity. We need not be always complicated and do too many things for wealth creation. You just need to do few things which are very simple and keep on doing it for a long period of time. That's how wealth creation happens, and that's what exactly passive investment does to your portfolio. So I'll just spend a couple of minutes to talk about what is passive investment, and then we'll move on to today's topic. So passive investment is nothing but you are trying to take advantage of the market wisdom. Okay, so what is passive investment? Passive investment, there is no active fund manager, dedicated fund manager who manages your money, who actually takes call on market, who understands and reads market. But there are few set baskets which that particular fund manager invests, and those baskets are called indices. Okay, like we know Nifty 50, Sensex, Nifty 100, Mid Cap 100, Nifty 500 kind of baskets. Okay, these baskets are as market starts maturing, these baskets become very powerful. And why they become powerful is very, very simple. As I said, it's a collective wisdom. So if you just look back 22 years or 25 years back or 27 years back, when SEBI was not there, right? And now SEBI has come in. Now we have two exchanges, NSE, BSE. Now there are 40 plus mutual fund houses. There are 40 plus insurance companies. There are thousands of FIs, institutions who invest, and there are thousands of brokers who invest in the market. So what they have done to the market, they have made market mature. And when market becomes mature, it's like, you are sitting in an IIT classroom where all the candidates are between 98 and 99%. Right. And 25 years back, the same IIT classroom was any public school kind of. So you could pick up, cherry pick some of the stars. But now it is not like that, and that's where, as market starts maturing, these indices become very powerful. It is not like that, active management is not useful. There is something called active strategies and passive strategies. India, we call active mutual fund and passive mutual fund. Globally, there is nothing called active mutual fund, passive mutual fund. Mutual fund means passive, and there are active strategies, which are like PMS, AIF, or benchmark agnostic strategies. If you look at Motilal Oswal AMC, we have active strategies also and passive strategies also. So, and globally, it's all 50-50%. So what passive does to your portfolio is reduces volatility drastically because you're with the market. Okay, and market is very powerful, right? As market starts maturing. And second, what it does, it reduces your cost. So in the longer term, you will realize that it is doing much better job, and you will be able to enter and exit market much faster than any other active strategies. Okay. As I mentioned, there are very simple, to know exactly what stocks you are buying, and it reduces your cost. That's how passive helps you. And passive should be part of your portfolio, whether it is international or domestic as well. Now, if you look at globally, pre-1960s, there was nothing called market return. After 1960s, what happened? There are market participants who identify there is a market return. Then there are some indices which actually average market return, and they try to generate alpha out of it. Okay, so they divided these returns in two parts. One which was market return, and second which is alpha. Okay, this alpha now, especially last or today's time, this alpha can be again divided into two parts. One is factor, and second is actual alpha. And actual alpha is actually difficult, very, very difficult. So we are going to talk about today factor, which are again a passive strategy. Okay, but these are passive plus strategies. That what does it mean? That means they also generally any passive fund will actually give you market return or slightly lesser because of the expenses. Okay, but these passive plus strategies, which are also called factors, they have a power to actually outperform market. Okay, so factors are globally very popular. They are becoming, next generation investment, and one should also look at in India. They are pretty new. But you should also know about it, how to look at them and how to invest. Today we are going to talk about it. So briefly, I'll talk about only one slide. What are factors? So factor, there are nothing but if you go watch any movie, any popular movie, whether it is the latest hot topic Kashmir, or you look at Pushpa, what you need is great story, good dialogue, star cast, music, all those things. So same way in any mutual fund portfolio, any investment portfolio, there are factors like low volatile stock, or momentum stock, or the value strategy, quality strategy. All those are actually called factors. Now these factors can be mathematically defined and keep it separately, and we can actually keep those separately. And these are all factors which is being used by any active fund manager to generate alpha. Now, by using these mathematical formula, which are very, very simple to understand, one can actually invest in these by strategies directly. Okay, so we already have a momentum fund, which we launched last month. Now we are launching low volatility fund. There are other two factors also known as quality and value. So these are all actually four major strategies on the factors. Okay. As I was talking about factors, so as I mentioned, there are some mathematical models. So you look at any particular stocks, 6 months or 12 months return, price return. You look at volatility. You look at some valuation like P, price to book, all those things. Okay, and then you rebalance it every 6 months. Okay, what is interesting about factor investing is they are not ambiguous. So if I talk about value, and if say Tushit talks about value, we cannot be different. Like if I talk about a momentum strategy, if Tushit talks about momentum strategy, cannot be different because it's a mathematical formula. Okay, so factor investing is nothing ambiguous. It's very simple to understand because it's just a mathematical formula. Okay, so this is called, I was talking about factor investing. Factor investing is growing globally. Currently, it's around 3.4 trillion is expected to touch this year, which is equal to Indian GDP number. Okay, so that's huge. Okay, but in India, it's still new. Now there are questions which is being asked. Which factor? There are, as I mentioned, there are four factors: momentum, low vol, quality, value, and there is an index. So which strategies do good? Which factors I will invest, which will actually give me fantastic returns? Looking at this chart, if you just look at the first row, okay, you will see that every year there is a new winner. What does that mean? That means, none of the factors are consistent. But this is what, as an investor, we always want to have, that the best of the performer always in my portfolio. That generally doesn't happen. Okay, one cannot time the market, one cannot know which factor will do well. But when I'll slide it through next few of the slides, you'll understand, when you stick to any of the factor and stay for longer term, it actually makes your life very, very easy. Okay. Secondly, what are we going to talk about today is something called low volatility fund. Okay, low volatility strategy. Now, this is again a dream portfolio for any investor who is in the market. Let me repeat, I just said it's a dream portfolio for any investor who invests in the market, because any investor who invests in the market always have, two major questions, two major problems or issues. One, he always thinks markets are very high. Second, he always thinks markets are going to tank tomorrow. Okay, and then because if these are the two risks are always there, I'm running, then how I'm going to make returns? Okay, so basically they're always worried that markets will not do well. Exactly, for such investors, this low vol strategy is a best suited strategy. Low vol strategy also we recommend to all investors who are very, very conservative, ultra conservative, okay, or who are investing for the first time in the market. But that doesn't mean that any investor who is a pro investor investing for like that last 2 decades now cannot invest in low vol. No, nothing like that. But it's a very good core portfolio which one can build, because it actually absorbs shocks of the market. Now I have, so the first slide actually confuses with a lot of data. This slide actually I try to answer. If you look at the center column, low volatility. If you look at, there are three phases which are covered: bull, bear, and recovery. So bull market and markets are consistently doing well, and this is last column is the market return, which is Nifty 200. If you look at bull market and markets are doing 33%, your low vol is doing 29%. May not be looking interesting. Okay, but that's not the only one cycle which we see. We also see bear cycle. Look at bear cycle. Bear cycle, markets are doing 42% negative. Low vol is doing 25-26%. Okay, so there is a profit of clearly 15% which you make. And if you look at from the bull market, you are not losing out too much, just 3%, right? But when market actually goes through bear phase, you actually make better savings. This is what every investors look for. And look at the recovery. So recovery is, when markets correct and then they start recovering. In that phase also, if you see, it is doing really well in the market. So there are three scenarios. Out of three scenarios, this strategy is doing pretty well in terms of bear also is not doing that bad, becomes very, very powerful. Okay, so somebody doesn't have to worry about markets are bull, markets are bear, or markets are actually recovering. If you just have this strategy, strategy will do much better job for you. Okay. So let's understand what are these low vol factors. If you don't understand any point which I'm trying to say, please ask questions. I'll be happy to clarify. Okay, so this is a strategy which we're going to talk about: low volatility. Very, very simple strategy. What we look at is the standard deviation of the stocks. Let me go directly to the. Okay, before strategy, yeah, let's talk about low volatility. So what is low volatility? It's very simple. Any stock which has, you can see the infographic here, which mentions, the volatility is lesser. That means the price return of a particular stock on a daily basis for last 12 months has been very consistent, or, it's not very volatile. That means one stock, for stock A gives you 1% return today, next day it is 2% down, third day it is 5% up, say fourth day it is again 2% negative. These are called high volatile stocks. Okay, and why this strategy does really well, so when you get into this strategy, so there is a anomaly which is being spoken in the financial market, which is very surprising. This is also called greatest anomaly in finance. Okay, so what is generally been taught in the market, that if you take higher risk, then only high returns are possible. Okay, so you have to take higher risk. If you look at the number one point here, so high risk, high returns. Okay, but the study shows that, if you have a defensive characteristics, you actually do much better job, in longer term. Okay, I have one more slide to talk about. Okay, so what exactly happens? Let me tell you by these 3 points. So why volatility strategy works, or low volatility strategy works. First is, let's understand lottery effect. And all of us know that what is lottery effect. Everybody wants to pay 10 rupees and try to make 1 crore, or to pay 100 rupees and try to make 10 crore. Okay. Same thing happens in terms of stock also. Investors try to pay for a stock which is high volatile. Okay. When stock is high volatile, it is high price than it's supposed to be. And then what happens? You end up paying more money to own that stock. Okay, so if you also look at any lottery investor or lottery buyer, he will always keep on buying 10 rupees or 100 rupees lottery every day. End of the day, end of the month, he might get 3,000 rupees lottery, but that's what money is invested, right? So same thing happens, they want to buy how they end up overpaying that particular stock. Okay, so high volatile stock, not necessary. They always do a high performance. Or the cost also goes much higher. Secondly, asymmetric returns. And in fact, when market corrects, especially in the bear market, when there is a big fall, what we are experiencing now, the low volatile stocks tends to fall less. Okay, but when they recover, when there is a good rally which happens, they also perform really well. Okay, I have a slide which I'll explain you more in detail because that will be in the chart. And third is overconfidence. Investor wants to buy such companies. They want to bet on such companies where their outcomes are very uncertain. This company might do well. This company is going to get some good order, and that's what I am betting it on today. Or some of the economic conditions might help this company. So these are all overconfidence also end up causing your high cost, and you end up investing in high volatile stocks and you don't get returns. Okay, what is this? I'll try to explain you. There are a couple of slides more, very simple slide. Okay, so what do we do? How do we select these stocks? So this is a passive fund, as I mentioned. Passive fund means there is an index. What is this index? So this index is called low volatility index. You can see here S&P BSE low volatility index. So this is a S&P BSE index we'll be using. How this index is arrived? So there's a first universe which is being taken, which is S&P BSE large and mid cap index, where there are almost 200 stocks, large cap and mid cap. Okay, in that first filter is put where the 30 top low volatile companies. That means all 200 companies. What do? We actually take price return volatility for last 12 months on a daily basis. So last 250 trading days. If you look at what is a daily volatility for all the stocks, and lowest volatile stock, lowest volatile stocks will be selected in this portfolio. Okay, it's very simple. There is no other formula. It's just the stock has to be low volatile. Now, it is also capped at 5%, so that we don't end up investing in overexposure to a particular stock, and only 30 stocks will be part of this portfolio. That means what are we doing? We are investing in large and mid caps segment. Okay, we are investing in focus strategy. Is also called focus strategy because there are only 30 stocks. Third, these are low volatile stocks, and these are also rebalanced every March and September. Every 6 months, this filter has been put, and new stocks which is being if there are addition or deletion which happens, and this is how these indexes arrive. So very simple. Top 200 stocks where you put the lowest volatility or volatile stocks will be part of this portfolio. Now, if you look at in graph, it has done really well. Overall, in last 15 years of time, and the gap has been increasing. That means the returns are much higher. Let me show you through a chart. Now, I also showed you that grid, all these 4-5 factors. Now, if you look at this annualized return graph, calendar year return graph bar, you can see out of 16 year, 9 year, this strategy has done really well. Okay, so you might say slightly above 50 to 60% has done really well, but that is not how one should look at this strategy. Okay, let's understand. Let's fine tune this, or let's go to 2008. 2008, when market fell 54%. Okay, this strategy just fell 42%. So there's a clear, less loss of 14%, or clear outperformance of 14%. Okay, but when market recovered in 2009, you can see the returns are equally same. This is the point which I was mentioning about asymmetric return. When market falls, this falls lesser, but when market recovers, the strategy does equal to market. Okay, and this you can see across the period. Again, 2011, market fell 25%. This was just 12.5%. So 12-13% outperformance. Okay, but when market recovered again, you're almost same. Okay, now when you add this 2008 and 9, you will see the strategy is doing much better job. Okay, so we should not be looking at from just only one angle that 9 out of 16 it has done well, or 16 out of 9 it has done well, but you should look at longer term. Now let's look at different financial crises that we have gone through so far. That is financial crisis, global financial crisis, 2008-9, taper tantrum, yuan devaluation, and COVID-19. So this strategy is actually saves. It's a protection from these corrections. So look at this. Market fell 43%. This fell just 32%. So 11% outperformance. Taper tantrum 7% outperformance. Yuan devaluation 8% outperformance, and here 10% outperformance. Okay. Now let's look at, this is the correction which we have seen. Let's look at in the same period, if market recovers, then what happens? Now in global financial market recovered, it's slightly underperformed, 6%. Okay, taper tantrum, it recovered slightly lower. It's like, again, there is a difference. Again, there is a difference, 18% difference. Okay, but now this previous slide and this slide, let's combine this and see. Now, when you combine this, there is a huge difference in outperformance. 18% outperformance here, 7%, 3.5%, and 6%. Now, why does this happen? See, when you fall lesser, you also have to rise lesser. Okay, there is a 50% fall. That means you have to grow back to reach to 100, again 100% to reach to your original level. Okay, so that protection which is given during market volatile or bear market, which helps you when market recovers, and that's why when you add this slide number 17 and 18, what you get is 19 outperformance. Okay, so this is a fantastic strategy which actually works as a cushion to, especially in all these pandemic times, or all these market crises. Okay, now let's look at the returns. Okay. Now, if you look at 1 year and 3 year basis, you might not be that happy. Okay, but if you look at 5 years and above, it has done really well. Now, 5 year also, you can see the returns are almost same, index and portfolio. Then how can you say it has done a great job? It's actually done a great job, because look at the volatility. Now, if you look at the second row, the volatility is just 14%, and index volatility is 18%. Okay, almost 25% volatility is lesser. That means your risk adjusted returns are much higher. If you're taking 1 rupee risk, how much return you're getting? Are you getting 1 rupee return or lesser than that? And you can see across the period, barring this last 1 year, 3 year, 5 year, 10 year, and 15 year, this strategy has done much better the job than market. And after, when you stay for longer term, it outperforms clearly. 3%, 4%, 4%, 3% outperformance over 10 period is huge. Okay, so this is a strategy which actually works as a protection to your portfolio. Whenever there's a market correction which you see, it actually works as a portfolio correction. But not only that, this is Nifty 200 index. Now let's look at Nifty 50 index. There also it has done a similar job. 5 year and 10 year and 15 year, it has done really well. Now, when we also say this strategy is suitable for all the conservative investors, who are ultra conservative investors, if they get 15%, 18, 70% return, it's pretty good, right? Because they never wanted to come into equity. But for those investors who are pro investors, and when they buy this strategy as a part of core means, their maximum portfolio as a part of this strategy, what happens is your losses are lesser, and over the longer term, your outperformance is visible and huge. Okay. These are its SIP returns, 19%, 16%, 15%, and 6.5%. Okay, let's look at rolling return. If you understand rolling return, or let me explain you what is rolling return. So there are 3 year and 5 year rolling return. 3 year rolling return, let's look at median return. So what is 3 year rolling return? So for last 15 years, if you pick up any 3 years, start from any day and end in any day, what are your median returns? Are 16%. Okay, and whereas index has just delivered 12%. Okay, so 4% outperformance. 5 year, when you pick up any 5 year period, start from any day and on next 5 year, look at 17.5. Okay, so there is huge 5% here also outperformance. The double digit return, again here 86, 87% of time you make double digit return. 5 year time, it's almost 97% of the time double-digit return. Okay, so the longer you stay, you make much better return in this strategy, and you actually outperform the index. Yeah. So why should you invest? I have couple of more slides, and then we can open up for questions. So why someone should invest? Good starting point for someone who's worried about market volatility, who's always worried the markets are peak, markets are going to fall, and especially whatever we have seen last 2 months, this becomes a great strategy. Lower volatility than market, that means lower risk. Okay, and long-term historical performance has been fantastic. In fact, it has outperformed the market, though it's a passive strategy. More effective, as you mentioned, during market crisis, and low-cost index fund and ETF. So we are launching an index fund format as well as an ETF format. Yeah, so this is the we are launching ETF, which will have 35 basis point of expenses. We are also launching index fund, which has 1% of expense ratio. Okay, as low as 500 rupees, one can invest, and then if is closing tomorrow. Now, just I'll cover quickly about which are the stocks will be part of this portfolio. So you can see these names like Gillette India, Maruti Suzuki, Pidilite, Infosys, so all quality names. So what happens to these companies, or what happens in the market, does not affect these companies, because their cash flows are certain, their business cycles are pretty much decided. Whatever happens, Pidilite will keep selling their colors, right? Infosys, Nestle, and that is why they work beautifully in market prices. So top 10 weighs 38%. Now let's look at how sectoral allocation has moved in last 6 semi-annual rebalancing. Okay, like every 6 months there is a rebalancing. So current portfolio says 45% consumer, healthcare 17%, financial services 10%, 7% your IT, commodities, and so on and so forth. But largely, if you look at, it is more of a consumer, because again, their outcomes are, the cash flows are pretty certain. Okay. Now the second which we are seeing is healthcare, which is again prominent, especially after pandemic. They have become very prominent. The cash flows are pretty certain. Okay. There are a few financial services stocks also which we see, and some manufacturing stocks also which we see. This is how they have moved. If you look at large cap and mid cap, last 6 semi-annual, largely, say 2 years back or 3 years back, it was largely almost large cap. In 2018, it was 95% large cap, but now it is 66-34 large and mid. So there are mid cap companies also there which are low volatile. They also have a certain cash flow and consistent cash flow that we can see. Okay. Yeah, so that's all from me today. Any questions which we have, we can take up. We also have Tushit, who is our quant fund manager, who has working on this strategy for a long period of time. So I'll be some of the questions I can look for his inputs as well.
Sure, because we just got a few questions in terms of various slides. So we'll take up these data questions first, and then we'll follow up with the other questions in the second half of the session. So I'll just, since we are on the slide, I'll just take those up.
Yeah.
So a question is in terms of whether the returns which you have shown on in your slide, whether the investment is done on lump sum or SIP basis. What was the starting point or the way of investment to achieve these returns?
So if you look at lump sum returns, these are as on month end, these are 31st Jan returns. Okay. Suppose when you say first year, that means we invested on for 31st March 2021 till 31st March 2022. Same where if you go 3 years back, 5 years back. So these are the lump sum returns. Okay. Now when we look at SIP returns, this is a slide. Again, same way, data is on 31st of March. So you have done SIP starting from last 31st of Jan, when you have done 12 installments. The valuation is of 31st. So same way, you go back 3 years with 36 installment, your 60 installment, that's how so and so forth.
Right.
Was there any other part of the question here which I missed?
The funds return in the past 3 years, any backtested data if you have?
Yeah, this
how
is
the
what.
strategy has performed.
Yeah, this is what the data which we are showing.
Right, right, right.
My slides, sorry, my slides. Yeah. So these are the backtested returns only. Backtested means this is the index which is there prevalent with BSE. Okay, so these
Mhm.
are the data of that index itself.
Right. And finally, if you can go back to that to the slide which showed various factors, how various factors have performed across periods.
Right.
So
Okay. Yeah.
yeah, perfect. So because I'll request you to hold on. I'll just cover IIFL's dedicated platform for ETFs over the next few minutes, and then
Yeah,
we'll
sure.
come back to the rest of the Q&A.
Yeah.
So friends, we will move into the second half of the session. I will just showcase to you all IIFL's dedicated platform called ET5. We have created this platform in order to resolve our investors' interest in terms of ETFs. However, they face challenges in terms of which ETFs to buy, how to buy, and how to make a robust portfolio. So what we have done for you all, we have created this platform so that it makes investing absolutely simple. I'll just share my screen. Vikas, can you stop sharing? Per- So this is IFL's dedicated platform for ETFs called ET5. You can reach this page by logging into indiainfoline.com and go to personal finance session, and you'll get uh, ET5 over there. So first and foremost, we'll just go back, although Vikas has explained to us about passive investing, and we'll just go into the features of why ETFs. ETFs basically are far cheaper than even direct mutual funds in terms of the expense ratios. If you look at an actively managed large cap scheme, for example, the direct plan will also have an expense ratio of over 1%. Whereas you get a large cap ETF giving you market-based returns at an expense ratio of just 5 to 6 basis points. So absolutely cheaper in terms of costing, being a passive strategy. Uh, ETFs are tax efficient in the sense ETFs replicate the performance of various indexes. They make portfolio changes as per the underlying index. So as we saw, the index every 6 months they rebalance their constituents, or they add or delete any particular stock. The ETF does it for you. So all that you have to do is buy an ETF and hold it. You will make market-based returns. If you try to do what the ETF is doing at an individual level, and if you say, for example, if you purchase the 50 stocks of the Nifty 50, and if you try and buy and sell, the tax implications would be far higher compared to buying a ETF and holding on to it. These ETF baskets are available as low as 500 rupees. In fact, thanks to slight market corrections, we are getting these baskets at lesser than 500 at this point in time. ETFs can be traded during the day. You can buy and sell an ETFs any point of time. You can take advantage of intraday volatility, buy low, and some particular day sell at the high point of the markets during the day. You do not have to wait like you wait for a mutual fund NAV, which you will get at the end of day. So you cannot take a benefit of intraday volatility in a mutual fund, whereas in an ETF you can buy during the day itself. These ETFs, there is no lock-in. You can buy anytime, sell anytime, no lock-in absolutely. And diversification benefit nowadays. So you have equity ETFs, you have debt ETFs, uh, commodity ETFs like gold, silver. So absolute amount of diversification is what you can achieve by purchasing ETFs. So make ETFs a part of your core portfolio is what we suggest. Uh, uh, in order to see your theme-based baskets, you need to click over your see portfolios. You will So we have created 7 portfolios for you. They're based on various themes. These are ETF based baskets. So when you say access hybrid wealth and answer, uh, you will part of the constituency basically. You'll have a debt 80% exposure to debt, 20% to equity. So if your aim is to beat inflation, generate returns at low volatility, this could be a suitable option for you. It's very working similar to a conservative hybrid debt fund. So you can create a similar portfolio for yourself and through access hybrid wealth and answer through an 80-20 kind of an asset allocation. Nippon India transformation, we have created this basket in order for you to capture the growth in the capex cycle in the economy. Uh, we believe the infrastructure sector is going to do very well given the government's focus in terms of boosting capital expenditure, and simultaneously even the private sector over the next couple of years will pick up in terms of capex. Hence, we believe this Nippon India transformation will do phenomenally well over the next few years. India consumer, this basket gives you exposure to consumer focused companies, not only in India, but abroad as well. So, a consumption themed basket, uh, there's a minimum investment of 427 rupees. Uh, you get exposure to domestic companies as well as foreign companies or international companies such as Amazon, Google, etc. Sustainable India, we have created this basket in order to cater to the demand uh, for ESG based investing. Uh, so through Sustainable India, we believe ESG is a theme for the next decade or so. Is going to do very well, and hence you can, by investing in Sustainable India, you can capture growth in ESG focused companies. Smart portfolio, uh, this is a factor-based portfolio which we have created. You have exposure to low volatility. It is a value-focused ETFs as well as gold. One factor I would like to highlight is given this theme, this basket works very well when there is heightened volatility because of its exposure to gold. If you see currently markets, these are pure equity kind of portfolios. Because of the market correction, they are generating a lesser return compared to a multi-asset portfolio uh, of smart portfolio. So given gold, it offers you a natural hedge in terms of times of volatility. You have emerging opportunities, which is a mid-cap oriented basket. So if you're of the aggressive investor type, you want to seeking higher returns, mid-caps is what you are like. Then emerging opportunities is the place where you all can invest. Similarly, India's top 250, this gives you access to top 250 companies in India, a large cap oriented basket. On clicking any of these baskets, you will get the entire composition, the overview. You can start an SIP as well as a lump sum into these portfolios. So take benefit of the market volatility, start an SIP in any of these baskets, and we believe you'll do seeming quite well in terms of achieving a various financial goals. This is the smart portfolio. See, like I said, gold has an exposure of around 10% uh, into this, and that's helping in terms of sustaining performance. So with that, we'll move into the Q&A section.
Exactly.
So, uh, so can you help us in terms of ETF taxation allows indexation benefit after 3 years? So I believe he's talking about debt ETFs. I think the indexation benefit is there, right, for ETFs
I
as
think there
well.
are three, four questions which has been asked by Mr. Mallikarjun only, so I'll just try to sum it up. Okay.
Yeah,
So ETF and fund returns, ETF and index funds are just a structure. Okay. If you look at underlying, there are index only. So as you mentioned, this fund which you are launching is in ETF structure as well as an index fund structure. The difference is the expense ratio. So in the ETF will charge lesser expenses, like as I mentioned, 35 bips, and the index fund will charge slightly higher, which is around 1%. So to that extent, the index fund will underperform. Okay, so that is only major difference. The second difference is for ETF buying and selling, you need to have a demat account, trading account, and index fund you don't need that. You can buy it through any other platform online without any demat account also. The second question which you have asked is about and how do you compare this with the uh, Bharat bond. Now, Bharat bond is a different category altogether. Okay, it's a debt, it's a different asset class altogether. Now, we are talking about equity. This is an equity asset class. So, within equity asset class, this you can say the safest portfolio that one can have because of the low volatility. Okay. There is one more question also about the mid cap. Yeah. So I think this is good, great question which you asked about mid caps. Now you can see around 34% in this portfolio are mid cap stocks. Okay. So will that affect my return? Will that give me negative returns? So what is the strategy that we are using is basically we are just buying all the stocks which has a lower volatility. Okay, so that can be a large cap or mid cap stocks. So that does not matter. Okay, and that's why you see this strategy has done really well in wonderful in longer term. So your question is majorly based on this slide. Right. So if you look at last 3 years, what has happened? The mid cap stocks have actually grown up. They have actually no longer you can say call them a junk stock. There are very good quality names also have present in mid cap stocks, and they are again highly researched. Okay, and they're still it's a portfolio as a large cap bias. So what we need is just a lower volatility. If the stock is not moving too much, plus or minus, that's what we need, and that's how this mathematical formula does. Now, if I apply this logic of mid cap should not be part of this, then my universe will change. Then only I will restrict it to large cap. Okay. And if you look at large cap and mid cap, there is only large cap low vol portfolio or large and mid low vol portfolio. Large and mid has done really well because mid caps have actually added returns in this portfolio. Okay, so your worry was, will it give negative return? In fact, it has worked the other way around. It has actually added returns in the portfolio. Okay.
right.
Then also you are asking ETF taxation allow indexation now. So ETF is a equity taxation. So short term is less than 1 year, long term is after 1 year, as compared to debt, which is 3 years short term. And so ETF, you cannot take indexation benefit, especially equity ETF. Okay, debt ETF you can. In current scenario and market has corrected in the current lump sum or SIP is better. Yeah, this is again a good question. So it depends upon what do you want to do. If you have lump sum and you want to forget it for say 3 to 5 years, lump sum still makes sense with this kind of strategy. Okay, but SIP is always better because we are going through market volatility and we don't want to have add a lot of losses in the portfolio. But such strategy works both. You can do a lump sum and SIP both in such strategy. Okay. Now there are some questions on chat box. So Mallikarjun sir also asked, what is a rolling return? I'll answer it later. Can you please show slide number 10? We have showed how much investment in ETF, mutual fund, equity of our savings. How much investment in ETF, mutual funds, or equity savings? Okay, this is again a good question. Okay, so whatever investment we do so far, what is our major portfolio allocation was FDs or post office, right? Because that is the safest and that used to give very high returns if you just go 10 years back, or for that matter, 5, 6 years back also, they used to get pretty good returns, especially 8% plus kind of return. But now those days are not there. And this especially this discussion which we are having is on wealth creation. And Ramdev ji always says, wealth creation is not possible without equity. Okay, so equity needs to be there to add wealth creation, because the compounding effect, when companies grow, when equity grow, it doesn't grow in percentage terms, say 5%, 10%. They grow in 3x, 5x, 10x. The businesses grow 10x, 20x. This is what Warren Buffett also says. Okay, so that is why equity makes sense and it should be part of our portfolio. Okay, now asset allocation is important. As I mentioned, you also need to understand what is your age, what are your goal. Okay, so any senior citizens or anybody who is above 60 should look at majorly into debt, say 70-30, or there are some senior citizens who are okay with 50-50 also. Okay, but if you are not at all investing in equity, I would suggest this is the strategy to start investing, because our worry of losing capital, making negative returns, market volatility, this is a strategy to be for any first time investor in equity, and also a pro investors, which can become part of his entire core portfolio of equity. There are some questions. Now,
Because
yeah.
can you help us in terms of the expense ratio for these low volatility fund, and together can you explain how why a low expense ratio is more beneficial to investors?
Yeah. Okay. So suppose you invest 100 rupees anywhere, any mutual fund scheme, and if I'm going to deduct 1% every year, your capital is gonna go lesser, so your higher expenses will always erode your capital. When you have a lower expenses, like active strategies tend to charge you high. Why? Because they are also promising you alpha. But in passive strategy also there are two, when you go through ETF, again there are expenses, like you can you pay lesser expense ratio, which is 35 to 40 basis point. Index fund you pay 1%, but again there are brokerage also which is being paid when you buy ETFs, and if the brokerages are zero or lesser, I think that's makes sense to go for ETF, if you want to really save cost.
Right.
In USA, ETF market share is higher than compared. Yeah, ETF markets are higher than India because of the primary reason is taxation benefit. Okay, there is a tax basically tax holiday. If you buy ETF, there are no tax. That is why most of the people have moved from index funds to ETF. Secondly, in India, the second challenge is when you want to buy ETF, you need to have demat account, trading account. This pandemic only, we could add 6 crores of pandemic demat account. They would agree with me. Before this pandemic, we just had what, 3 crores or 3.5 crores demat account, and active, if you look at, just 1 crore. Okay, so that was a major hindrance in growing ETF market. But now we have 8 crore plus ETF account, demat accounts or trading accounts. Now we can see this ratio going up. And the portfolios we just Headley showed you, they are making curated portfolio for you for ETFs. So if you just select one, they will buy underlying 4 or 5 ETFs. I think those things are very good for promotion of ETFs, which IIFL is doing fantastic job. Are we getting
Thank
return
you.
more than FD return post tax? Definitely. When you go to equity will always give you higher return than FD, because it's a capital investment which we do. But if your horizon is 5 years, definitely it will give you much better return post tax, if you have at least 5 years plus looking at. In fact, this strategy will do much better than the index also, market also.
Right. Because can you, given that most of the stocks in the portfolio are consumption, so we just want to understand, given that raw material prices, logistic costs, and all are on the rise, hence will profitability of the index constituents be affected more compared to say the Nifty? In case you have any statistics on that, I mean, is there any study you all have done in terms of the impact in terms of profitability?
I'd like to invite here Tushit, because Tushit is tracking all these sectors very closely. Okay, Tushit, your input on this?
Yeah, so obviously inflation impact will have over to the basic raw material costs. But what we are going to look at, say for example, you look at the basket that we have here. These are also industry leaders, correct, which have very high market share. They command a very high market share over the overall, and hence they are the price setters overall. So most of these industries that we will see will be able to basically pass through a significant amount of this cost down the line. Correct. So that is the overall impact that we have. That is the overall idea that we have. Uh, sorry. Whether the overall long-term inflation and rates will impact the overall portfolio differently, it may. But if it does, if it impacts the volatility of the overall stock, then yes, automatically you will see there will be a shift that will be there. So if I'm telling you today that my defensive portfolio, within the defensive portfolio, my FMCG ratio is relatively on the higher side, that is just for the past 6 to 7 semi-annual rebalances that you have seen. Correct. If you look at across history from a longer point of time frame point of view, you will see that we have had very high IT exposure as well. We have had very high exposure to FS as well, financial services as well. So at the end of the day, it will play a counterbalancing play in itself. It will try to pick those sectors which will have relatively low momentum, or which will have relatively low price volatility and more stability. Correct. So these are basically businesses that you would want to own from longer time frame. So the idea is to not just look at the pure sector point of view. You have to look at from a bottom up point of view and be more stock specific in that sense. That's the overall idea.
Right. That was helpful, Tushit.
Yeah.
In terms of in terms of passive investing, Vikas or Tushit, anyone can answer this. There are globally actively managed ETFs as well. So do you all see scope for this in India?
Come again? This question.
Globally, there are actively managed ETFs as well.
Yeah,
So,
yeah, yeah.
do you all believe there could be scope for them in India as well, or we are still at a very infancy stage in terms of market awareness about ETFs?
Yeah, so market dynamics are very different in India than US, because US is a huge and mature market, right? Factors are just we are introducing now. Active ETFs are much. It's again a long step to go for, but definitely the way, if you look at international funds, the last 3 years nobody was talking about international funds. Now international funds have hit their limit. It's we had to stop the investment. Right. So as the awareness will increase, as the market maturity will increase, definitely a lot of new such concepts will come in India, but that's a premature stage as of now. You have to wait and watch.
Right, right. Yeah. So with that, I think we've covered all the questions that we had. I would like to thank you and Tushit for helping us with this session and helping us in this aim which we have to increase awareness about ETFs and passive investing. I would like to encourage our investors to look at MOSL's low volatility fund as a good option in terms of their investing options which they have because of the promise in terms of low volatility which it brings to the overall portfolio. So it's a very promising investment option. So I would suggest our investors to look at it more carefully. I would also like to thank Prithviraj for helping us in coordinating this session. Uh, Thank you, one and all. And Vikas, if you have any final words, if you would like to help in terms of final words for this topic.
So thank you, Headley. Thank you, IIFL Securities, and thank you all the investors for joining in today. I think fantastic efforts and initiatives taken by IIFL to promote ETFs and simple investments for investors, direct investors. And one should start investing, and they should have a measure of their portfolio in mutual fund, because it has that power of equity, and ETFs and index funds make it simple to invest. And low volatility, what we spoke about, is a very, very good starting point. It can start and it can continue to have a core portfolio as well. So I think Tushit has some points to cover. Tushit, fine.
Yeah. So obviously Vikash has already given you a brief on why ETFs are important and everything. The only point that I would make is that low walls are a very important portion of your core basket, correct? And should be an important portion of your core basket. If you're someone who's new to investing, if you are allocating at this point of time, uh, make sure that you consider, correct? A lot of people think that from a long-term perspective, if I'm a buy and hold investor, volatility should not matter to me. Correct. And that is why I always give a very brief idea, and I hope if this is visible here. Right, you have three stocks: stock A, stock B, stock C. Right, you see period one returns, stock A falls 50%, recovers 100%. Stock B falls less, recovers less. Stock C falls even less and recovers even less. Correct. Average return in all of these cases is 25%. Correct? But if you look at it closely, everyone would like to buy stock C because your CAGR returns are 20%. Correct? A stock that falls 50% and only gains 100% is not going to give you any return. What is the difference between these three strategies? The only difference is volatility. Correct? So stock A is the highest volatility, stock C is the lowest volatility. So if I do this same exercise over different ranges, what I will find is as my volatility keeps on increasing, the compounded return keep on decreasing. Correct. So if you want to invest from a long-term perspective, want to compound your wealth a lot, correct, volatility is actually very important to you for a buy and hold investor. So that is why I would normally recommend to start investing in those type of securities or these type of baskets where your volatility is low, and hence you get that benefit of compounding in the long run. That's the overall idea.
Perfect and very well put, Tushit. Thank you so much for that. Um, so with that, we will come to a close. Thank you, Vikash, Tushit, and Prithviraj once again. Thank you, audience, for joining in and helping us with your queries. I hope we've answered most of your queries. Uh, we'll keep having similar sessions. I hope to have Vikash and Tushit back with us soon. And thank you so much, everyone.
Thank you, Andy. Thank you, IIFL
Thank you
Securities.
so
Thank
much.
you.
Thank you.